Great, thanks, Ryan. So we're going to take a look at a viewer email that we received. It's a pretty direct question here. It's about NowVertical Group, NOW, on the TSX Venture Exchange. He says it has 10 times potential. Have a look at it. So straight to the point, he wants to know if this company that he likes would be classified as one of our 10-time potential companies. And I think this comes from one of the recent DIY seminars that we did that focused on 10 times small cap stocks. So Ryan's talked a lot about that. I said at the start of the podcast today, I don't know why I'm doing this segment. Ryan is the one who is the 10 times guy, or maybe Brennan is the true power behind the scenes, but not me. But anyways, I'll do my best, and these guys can chirp in when I'm finished here. So NowVertical, what this is a technology company. It's data analytics and AI solutions. So they provide these services to private and public enterprises. I operate in the big data industry. And essentially what they do is they're providing software solutions as well as professional services to companies that have data and want to find a way to monetize that data, to turn that data into actionable intelligence so that they can essentially become more competitive and serve their customers better and ideally expand their market share. This is a micro cap, perhaps even a smaller than micro cap company, Pico Cap, a 43 million market cap right now, 50-cent stock, and 87 million shares outstanding on the company. So if we look at how the company's done, NowVertical has performed over the last year, you could see it was pretty dismal up until about November when the stock started to take off. And since then, going from a bottom of 8 cents to now up to almost 50 cents. So what happened at the time? Well, first of all, there was the release of the Q3 2024 financial results, and we'll take a look at those in a couple of seconds. Those were strong, and there were some things that the company was doing that the market liked. And then later on in November 26th, I believe, was the announcement of a partnership with Microsoft as well. So stock has been performing extremely well. Let's take a look at those financial results. So if we look at the financial results at face value, revenue is actually down 29%. But what's happening here is the company is refocusing its business. So it's divesting or selling some of its assets, presumably assets that are not as profitable or assets that they don't see as being core to their business or having that long-term growth profile. So revenue was down, but if you were to exclude the divestitures and just look at the organic business, the assets that they're keeping going forward, those revenues grew by 9%. A gross profit margin was fairly stable, down just slightly. Adjusted EBITDA again was down, and this was large. This was due to the divestitures. But net income was up, so up 144%, but really minimal net income here. I mean, 600,000 for the quarter, up from 200,000, but still seeing that go in the right direction is a positive signal. So basically what they're doing is they're addressing what they believe to be a critical need in the market. And that's that there are enterprises, companies out there, they need to find ways to be more competitive, to be more efficient. AI provides that solution, but most of these companies don't have the expertise to implement it. So NowVertical is the type of company, they're coming in with the software solutions, the expertise to essentially help these companies utilize their data in the best way possible. There's certainly a big market for this. It's an understandable business. There is market demand. I think there's also a lot of competition, but the top providers are going to rise to the top. There will be competition. Most of it will probably not be top tier. So for those companies that can provide a great service and great expertise and solutions, I think that there is an opportunity here. Now, part of what the company has been doing is they've been refocusing their business. They call it the one brand, one business strategy. What that is including is divesting a lot of their assets that they don't want to keep long term, and then really focusing on one unified business that is transitioning to profitability, or that will be profitable long term. So we love that focus on profitability. Too many companies in the micro cap and small cap space, particularly in the technology space, they don't prioritize profitability. But we've seen it many, many times before. If companies continue to burn cash, they have to go back to investors, raise more money, take on debt. it generally doesn't work out well for most long term. So we do like that focus on profitability. Now, looking at the historic performance here, there's really only a couple of years of record of the company as a public entity. So we only have 2022, 2023 really. And we did see from year to year very strong revenue growth. Now, for the 9 months, again, revenue was down for the year to date period in 2024 compared to last year due to those asset sales primarily. Now, there is a bit of an issue here, and that issue is with the company in this transition, in the process of selling assets. It's really hard to get a feel of the what the business is in terms of how much of the revenue growth was coming from the assets that are going to keep going forward, how much is attributable to the assets that are being sold. So it really kind of muddies the water. It creates a lot of smoke here. It makes it a little difficult to analyze. And when we have that situation, we really need to take our time to understand exactly what is being sold and what is being kept and how that factors into the historical and future performance. But just on the note of profitability here, again, this is not a company that has what I would say fully transitioned to profitability. They're in the transition. Historically, in the couple of years that we have, they were losing money. For the first 9 months of 2023, they lost 3 cents. And then for the first 9 months of this year, they gained a penny. Again, we don't know exactly what assets are contributing or taking from that. So it'll be good to have, it'll be better to have a cleaner picture of the company once they're finished with this transition of selling some of their assets and the reporting results with the new business. Looking at the balance sheet, there is some debt, about just under 15 million in debt, 3.3 million in cash. Now, there is not really enough EBITDA to make a calculation here. I'm kind of looking forward here. The company did indicate in their presentation that they, 8 million in EBITDA, adjusted EBITDA, 2 million in the last quarter. So you just multiply that by the 4 quarters. That's a pretty quick assessment. I mean, I would not depend on that as being something that we can look at going forward. But just to get some context here, if we were to use that, that would be net debt to EBITDA of 1.43 times. Not a bad leverage ratio. But again, we're talking about a small microcap, picocap company that is not yet fully transitioned into profitability. So ideally, we would like to see no debt to this business. But that may be what the company is looking at long term as well. And then just in terms of valuation, I'll just go off again that 8 million in annualized adjusted EBITDA. And then if we were to calculate the enterprise value, that would be an EV to EBITDA multiple of 7 times. Given again the fact that there's not really clear profitability here yet. It's unknown what the future revenue growth is going to be, or it's difficult to target it at this point in time. 7 times is not what I would consider to be an extremely attractive valuation for a company of this size and in its position. It's not bad. I would probably consider it to be more fair value. Now, our takeaway, we do think it's an interesting business. I do think it's understandable. There is a market there that they have the opportunity to capitalize on. And we like the idea of the strategy to transition the business and focus on profitability. Strong revenue growth historically, and there's the signs that they may be transitioning into net profit. But on the negative, it's complicated to analyze with everything that's going on with the company right now. There's only a few years of history we have with them as a public company. There's no operating cash flow at the moment, even though there's some positive earnings. The balance sheet and the valuation, they're okay. They're not what we would consider to be especially strong. So our take, we think that it is worth following this company over the next couple of quarters, and it does have great potential. I'm not going to come out right now and say that this is going to be the next 10 times stock. They have a lot to prove. What we're going to be looking for is for them to, create or provide a cleaner picture of the company going forward and more consistent net profit, and then growth and margin as well, along with revenue growth over the next 2 to 3 quarters.
Yep. I don't think you understand the technology. Just kidding. No, that
No,
was a good
I'm
summary,
sure.
Brad.
I mean, part of the reason why I really wanted to do this company as well is because I knew that, I would get trashed in the comments, and I love the
No, good
attention,
stuff.
I guess. So,
Yeah.
no, but I
Positive
don't
or
think that I said
negative.
anything bad.
Yeah.
I think that, they're doing some interesting things. And I like the market, but it just, for our criteria in terms of the profitability based criteria, it doesn't hit that yet. And I'm not confident enough that we're going to see a big explosion in earnings over the next 1 to 2 years. It may happen, but it's a show me situation.
Yeah.
Yeah, it certainly, as of yet, doesn't have the track record in terms of earnings that we're typically looking for when we're looking at the next 10x stock. And when I presented on this, you need, it is a small company, so it checks off that criteria. Like, it's about 87% of all companies that went up 10x in the last 10 years, essentially, started small. It's 80 something percent of those 82, I believe, were profitable before, and 91% had profitability prior to that. So, but this company is kind of just on the edge of that profitability. One of the things I would note is typically we're looking for a stronger balance sheet to start. You can't always have that, but a little bit stronger balance sheet would be good. And I do note on this company, if we look back to 2020, I think they had 14.9 million shares out, 2021, 40.1, 2022, 63.4, 2023, 75.6, and then trailing 12 months or it's trailing 12 months is about 80.6 right now. So, increasing that share count significantly over time. So what drives the stock price over the long term is per share cash flow and per share earnings growth. So they're fighting against a higher and higher share count. It's harder to grow per share earnings. And Aaron talked about a lack of operational or cash flow just in general at present. We'd like to see positive cash flow. So those are some other boxes we'd like to check off. It's moving in the right direction. Obviously, we'd like to see a focus on profitability. For the valuation, that's a forward multiple you're doing, EV to EBITDA there, right, Aaron? With a 9% potential organic growth rate, it might be, just fairly valued right now, if they can continue to grow at that rate. If they don't, it's not. I did note too, when I looked at the company, they had a spike up in adjusted EBITDA. Now they've sold off businesses, so it's not like to like, but they had a spike up from Q1 to Q2 to Q3 in 2023. It went from 3% adjusted EBITDA margin to 11 to 18. And then it dipped down in this transitionary period, this strategic shift period, down to 8% in Q4 of 2025, then 11 in Q1 2024, 14 in Q2 of this past year, and the last quarter, 19%. So going in the right direction again. But, is there a step back? Maybe they keep moving forward or maintain these margins, but you have seen a spike up before, which you could have made a good case this business is heading in the right direction. And then, boom, they made a strategic shift and you saw a drop down in that EBITDA. So volatility there, looks like on the right track. Perhaps we'll interview management, but there's some things that don't meet our criteria at this stage because we have a very stringent criteria. So